Hi, it's Chris Davison, and I want to take you through some testing we're doing on an EA which trades a surprise trade, which is Rob Booker's trade for very early on in the Boscillator range when price is just beginning to move away, wrap itself around the 800 simple period moving average, and then move away. And it comes with a health warning, because the way it works is to take potentially a large number of small losses in return for capturing what is quite a big win. And to give you an example, the reward to risk is over 10 to 1. And so what you get in this 10-year equity curve on the euro dollar are periods of time when you are getting consecutive losing trades. Now, this version I'm testing here is very early beta testing, and I haven't started using move to break even on it yet. But I wanted to show you that even though you can have a large number of losing trades, fairly regular small winners help over a consistent period of time help make that a very positive and healthy equity curve. Now, if I show you the results of this, it only wins about 15% of trades, which means that 85% of trades are losers. But the average profitable trade is 190 pips, and the average loser is 20, which is what gives it its very healthy balance. Now, over this 10-year period, it took an initial deposit of 10,000 virtual dollars and grew it by 6,000. Now, you may think that over 10 years that's not a particularly great return, and there are plenty of other things you could do to turn 10,000 into 16,000 over 10 years. But what I want to do is to optimize this now, or test it using the optimization function, and look at what those returns would be if we said, rather than a fixed loss size, we were going to trade with each trade risking 1% up to 5%. So I'm going to optimize that and set this running, and I'll come back to you with the results, because I think you might be quite surprised. Okay, the results have been run of the 5 trades, and if we look at the optimization graph, you'll see there's a curve here which basically says that the bigger the percentage, the bigger the reward, but not by much. And if we look at the results, then if you were to use 1% per trade, then rather than a gain of $6,000, $6,500, you get a gain of 93,000. Move that up to 2% and it goes up to 113,000. Now, remember, this is back-tested data. This doesn't mean this is going to happen going forward, but it just does show what the difference between using a fixed lot size, which doesn't grow as your account as your trades win more and more, versus the percentage at risk approach, where as your account grows, the amount you're risking gets larger. And the reasons that these aren't getting particularly bigger, the reason that 2% doesn't give you as big a return as 1% is because when you've got a graph where you're getting lots of losers in a row, you will get drawdown. But over this period, by using 1% at risk, you would get substantially better results than using a fixed lot size. And 1% is a reasonable amount of risk to take. But don't forget that if we look at the 10 years testing, the largest number of consecutive losses was 26. So the very worst case scenario in this setting was 26 losers in a row. Now, we can reduce that using move to break even, and that's my next piece of testing. But even with all of those caveats about a 15% win rate to an 85% lose rate, a situation where you can potentially lose 26 trades in a row based on staking 1%, based on historical values, historical results, you're looking at turning a $10,000 account into a $93,000 account, and that is not a bad return, and is absolutely the sort of thing we should be aiming with continued automated trading. Thank you for listening. This has been the testing of Surprise Bot.